Welcome to the Future Generation 2022 Results Webinar. My name is Caroline Gurney and I'm the CEO of Future Generation. I would like to acknowledge the Gadigal people of the Aurora Nation, the traditional custodians of this land where I'm sitting, and recognise their continuing connection to lands, waters and communities. I pay my respects to elders past and present. I am really delighted to be sitting here and to be joined by two of our leading pro bono fund managers, Mark Landau, co-founder of L1 Capital, who manages funds on behalf of Future Generation Australia, and Jacob Mitchell, founder of Antipodes Partners, who is the Future Generation Global Portfolio Manager. We will also have Geoff Wilson, founder of Future Generation and Wilson Asset Management, and he will be joining me in the second half of the webinar to discuss our 2022 results. As you all know, Future Generation companies are unique. The Future Generation companies are Australia's first listed companies to provide investment and social returns. We offer a unique opportunity for shareholders to invest with leading Australian and global fund managers while supporting youth-focused not-for-profit organisations, or charities, as you will. In order to achieve this, all of our pro bono fund managers, including Mark and Jacob, waive their usual management performance fees, and this allows us to donate 1% towards improving the lives of young Australians. As we all know, we've all lived it, 2022 proved to be a challenging year for equity markets. Despite this, we were really pleased to be able to increase the dividends for shareholders in both companies and also to donate $12.13 million to our not-for-profit partners. Geoff and I will discuss performance, the dividend outlook and our social investment later on in the webinar, and also take shareholder questions. So please, thank you to everyone that's already sent them in, but please do send more in the box provided. I've asked Mark and Jacob to discuss their market outlooks, highlight some investment opportunities, as well as answering any shareholder questions. So let's get straight to it. Mark, Jacob, welcome, and thanks very much for being with me today. So for markets, as I've said, it's constant negative news flow. It's been very volatile. So for how is 2023 shaping up for you? Perhaps, Mark, if you could give us a brief market outlook and let us know how you're positioning your portfolio to cope with what's happening out there. And then if we could perhaps go to Jacob. So Mark, over to you. Thank you.
Thanks so much for having me. I feel like a bit of a party pooper because I'm relatively cautious, and it's a big contrast in terms of how we're positioned at the moment versus how we were positioned for most of the period following March 2020 when COVID hit. And essentially the situation today feels like a complete inversion of what we've experienced over the last few years. So going back to March 2020, valuations were amazing. The ASX 200 was at 4,500. Today it's at 7,000. The S&P 500 at that time was at 2,300. Today it's at 4,000. So we've gone a long way in terms of recovery in share prices. And at the same time, you've seen interest rate policy dramatically change. So we've seen huge increases both in Australia and the US in terms of where interest rates are. We've got an enormous amount of pressure on cost of living for most consumers. And when you bear in mind that GDP is around about 2/3 made up of consumer spending, that's obviously going to have a big effect on the growth outlook. At the same time, you've got a bit more tail risk than what you had previously. Geopolitical risk, we think, is elevated, is likely to stay elevated. It's not just the Russia-Ukraine situation, it's also the China-US tensions, including Taiwan. The situation in the Middle East isn't getting a lot of airtime, but that's something that's lingering in the background. And we also think from an earnings point of view that you've been in this persistent, strong earnings upgrade cycle. A lot of corporates were beating expectations as their cost base is being cut during COVID, and revenue for most companies bounced back strongly. Now we think we're going into a gradually more difficult environment where costs are putting a lot of pressure on corporate margins, and at the same time revenue is likely to slow. So we think there's a number of reasons to be a bit more cautious in terms of how we're positioned, and also I think how people should be thinking about the outlook for equities in general. We've got a fortunate position. We're able to go long and short in our portfolio. It definitely is a nice feeling to be able to, I guess, punch with both hands. In terms of how we're positioned generally, we've reduced our net long from around 100% in the middle of last year down to around 50%. So essentially we're holding half of our portfolio in cash. And the hard part within that is to work out where to position, because essentially defensive stocks, which is where you would naturally gravitate to, they're actually very expensive and very crowded. So it's a part of the market that even though intuitively you might like, we can't make the numbers stack up from a valuation point of view. So a lot of those typical stocks that a lot of retail investors would be holding, a lot of healthcare stocks, supermarkets, toll roads, even CBA, we think they're all relatively fully priced, and you really have to go outside of that to find opportunities where both value and quality are available. So hopefully it gives you a sense of what we're thinking, and I'll turn it back to Jacob.
Yeah, and thanks, Mark. I mean, I would, and thanks, Caroline. It's great to be here. Look, we would, Antipodes Partners, we really, we would sort of agree with a lot of those, a lot of those views. There's building risks as a result of, central bank policy during COVID. You had central banks amplifying really loose fiscal policy. So probably doing the opposite to what they should have been doing. They should have been sort of in some ways acting in a counter-cyclical manner, but they weren't. They were actually, adding fuel to the fire, and that got expressed in asset prices. And now they're really mopping up the mess in terms of we've got this inflation hangover, but the Fed has been tightening aggressively, probably a lot more aggressively than other central banks. And now you're starting to see the consequences. Inflation's probably coming down, but we're starting to see real stresses appear in the in the financial system, and it's kind of no matter where you are in the world, it's roughly the same issue. Short end rates went up very quickly, and anyone who pays has a lot of leverage and is paying and is exposed to variable rate as opposed to fixed rate is starting to feel the stress. So it's households, it's certain parts of the corporates. And we don't think that's yet priced into earnings. It's certainly not in the, in the case of the US. As a global investor, I suppose when we think about where it is priced in, it's probably out more outside the US than inside the US. If you go to China, for instance, and we acknowledge the geopolitical risk, but China did something very, did the opposite to what the Western central banks did. They actually tightened coming out of COVID, and Chinese economy is actually coming out of a recession. You've already had a downgrade, earnings downgrade cycle, and your starting multiples are quite low. They're at around 11, 12 times. Whereas you go to the US and you're on 18 times, and you've hardly downgraded earnings at all. You're about until recently, earnings expectations were flat, which is incredible given how the shift in interest rates, which will ultimately impact housing and impact the consumer economy with a lag, but eventually it happens. And we're putting those high earnings on a high multiple. And Europe is somewhere in between, but certainly a lot cheaper. Europe had the energy crisis as a result of, and it was actually, the spike in energy prices in Europe, what it did was it actually probably brought forward a downgrade cycle. And now as energy prices have normalized, you're actually, we think Europe can actually muddle through probably better than expectations. So, to summarize, pretty cautious on the US. Where anywhere in the world where we think the recession's not priced, we're relatively cautious, and a bit more constructive on regions or parts of the market where we think you're already pricing in a fairly pessimistic scenario. And the global fund that is a part of the Future Gen Global portfolio is our global long fund. But similar to L1, we also manage a global long short fund. So we're probably finding it's an interesting environment. You've got a lot of macro dispersion and a lot of single stock dispersion. So it's a more interesting environment, I think, generally for active management.
Thank you both. So as you've mentioned, as we all talk about, one of the key reasons for market volatility is inflation and rising interest rates. What do you both think in terms of when will interest rates peak? I mean, maybe Jacob, you could talk about global, and maybe Mark for Australia. What are your thoughts there?
Yeah, look, I think they're peaking right about now. I think maybe Jerome Powell has to do one more hike just to save face, but I suspect he probably doesn't want to do that last hike given the issues in the regional banking sector in the US. which is a result of it's a combination of things. I mean, there's some idiosyncratic issues. Obviously, the regional banks, are pretty short capital. They don't have a lot of capital buffers, and they don't have great business models, which means they end up being quite exposed. As interest rates go up, their profits get squeezed because they can't reprice their lending, right, in the same way that, say, European banks can. So, you've got now signs of stress, and you've got the issue of Credit Suisse in Europe, another major issue for the financial system. So I think, in the US, I suspect you're right. You're there right now. Inflation is rolling over, and the Fed is going to start to think about financial stability ahead of fighting inflation. And I think eventually, you start to see unemployment sort of rising in the US, and the Fed will then have to start to focus on employment. And in Europe, we saw a 50 basis point rise just the other day. That's they're a little bit behind the curve, and we think Europe will have to play a bit of catch up. But they're really going to be quite sensitive. The ECB will be very sensitive to, to what's happening at Credit Suisse. And then you have the Bank of Japan, which hasn't even started to tighten. Doesn't have as big an inflation issue, but, ultimately they will have to sort of normalize their, interest rate policy.
I guess, in terms of Australia, the story is relatively simple. I think the RBA is very close to the end of their tightening cycle. We may see one more small rate rise. For most people on variable rates, they've gone from roughly a 2% mortgage to somewhere between 5 and 6, and we're yet to see the impact of those rate rises flow through to economic activity and consumer spending. The other thing I'd say is that it's probably helpful for the RBA that the Fed is likely closer to the end of their tightening cycle as well, in terms of the flow and impact for currency. And I think that the RBA would be trying to strike a balance between making sure that they slow the economy and slow the pressures that were pushing inflation to higher levels, but also not to over-tighten and result in a situation where you effectively have to backpedal, and which is obviously not ideal from an economic point of view, and it's not ideal from a credibility point of view either. So my guess is that the RBA is pretty close to the end, and we'll soon find out if that proves to be a good prediction or not.
Thank you. So we obviously just had the reporting season, and both of you, I know, would have been extremely busy speaking to CEOs and CFOs throughout that time, both here and globally. One of our shareholders, I'm going to paraphrase her question, asked, what trends are you actually anticipating coming out of your conversations, but from reporting season generally? Maybe if I can go to Mark, you first.
Sure. I might just comment on Australia. We obviously meet with lots of companies overseas as well, but I'll leave that for Jacob to comment on. In terms of Aussie companies, it's a really interesting point in time. Most companies reported relatively strong results. Most companies were upbeat on the results they were delivering, but as soon as you started talking about the next 12 months, there was probably a higher degree of uncertainty than what we're used to hearing. Part of that is what we've seen in interest rates and cost of living pressures. Part of that is a bit of uncertainty about labour shortages, which were very prevalent as a topic in lots of different sectors and lots of different companies that we met with. And I think the other one is a bit of uncertainty about how things in China play out. It's obviously been a big shift just in the last few months in terms of going from COVID zero policy to reopening, and to what extent China will stimulate their economy, and also to what extent you start to see an improvement in relations between Australia and China. So there are a few of the things, and I think the labour shortage issues are probably the most consistent topic that gets raised without even mentioning it in many of the meetings that we had.
Jacob?
Yeah, look, in the US, it's really almost the tale of, it's almost like a two-speed economy. You're starting to see just in the last, the last couple of months, you're getting a little bit more narrative around a weakening of the consumer environment. It's not falling off a cliff, but you are starting to see some discussion around, and it's mainly, let's call it more housing exposed parts of the economy. as you know, interest rates and the way the interest rate market in the US works is they don't have variable rate mortgages. So when you lift rates, it's really the marginal buyer of a house that gets hit by the higher rate, whereas the existing mortgage, households are able to lock in at a very low rate, and so their spending is holding up, but that new build activity in the US is really starting to weaken. Secondly, look, the industrial economy is doing quite well. Now that's a function of some of the policies that are in play in the US, whether it's the CHIPS Act, the Inflation Reduction Act. You're starting to see ongoing, a fairly resilient industrial sector. This sort of reshoring activity. Now, also the auto market was the part of consumer spending in the US that was below trend because of chip shortages. So that part of the economy is also holding up. So the US and US companies have actually come through in relatively good shape at this point. But there is discussion about weakening in IT spending. You can see it in the results of Microsoft. You can see it in AWS in Amazon. Corporates are moderating. They're preparing for tougher times. So they're reining in IT capex. Projects are getting deferred. The rate of movement to the cloud is slowing down. And I think that starts to, that will bite over a longer period of time. And then if you go to Europe, look, the companies have navigated a pretty tough energy market, and that's starting to get a bit better. So they're talking about, they're actually come through their earnings, I think, in a slightly more optimistic outlook, versus say where we were 3 or 4 months ago. China's a different. China has fundamentally, shifted, and we noted in the tone of corporates. Their results were weak, but their forward guidance is actually relatively constructive, and that's a standout. And I think that's critical because China's the one market where you haven't really had an inflation issue, and it's the one market where you can see central banks can actually proactively ease, and that's what they've been doing without stoking the fires of inflation.
Thank you. So you've been talking obviously to a lot of companies, both here and offshore. So maybe if I stay with you, Jacob, perhaps you could give us a couple of companies that you think are exciting to you at the moment.
Yeah, look, we certainly, I'm not sure they will sound like the most exciting companies because I think it's an environment to be relatively, defensive, at least in the West, because Western economies, we've got to go through, I think, a bit of a tough period where unemployment will go up. So we're looking at companies. We've been invested in a number of pharma stocks for quite a while now, and given everything that's going on in the world, we're always surprised that you can get these businesses that are very resilient relative to the economic cycle. They have pipelines. Merck and Sanofi, they're not. Some of their peers would have issues in regards to having not invested in the development of new drugs versus these companies that have, and therefore are not as exposed to, let's call it, patent cliffs or patent expiries on key drugs. And those stocks are trading on 14 times or lower type multiple for what we see as 9 to 10% type EPS growth, and and in EPS growth that's very low risk. So we're pretty constructive on that space. We, as you may have gathered from my comments around China, I think it is the one part of the world where it will, you should be looking for some excitement, as in good excitement, looking for cyclicality, looking for companies that are going to benefit from an upswing in consumer spending. Because China was in COVID zero for so long, they do have that. They build up those surplus savings. We think that's roughly 15% of income. And those surplus savings will start to be spent as China reopens. and it will be out of home spending. It will be travel, entertainment, and getting exposures like a life insurance company, which hasn't been able to sell its product, like Ping An during lockdown, where face-to-face selling was very, very difficult, or a company like Medea that makes air conditioners, and it's a high-quality manufacturer, but has a great lock on its consumer. As as people come back and start buying, participating in the real estate market, their business will do better, and the starting multiples are very low.
Thank you. And now to you, Mark, for a couple of stock picks, please.
Sure. I guess one of the areas that we think is particularly exciting are copper stocks. And the reason is that you've got a commodity that's traditionally been relatively unexciting. It's it's an industrial commodity that's used in lots of different appliances and applications globally. But we're now at the point where we're at this huge inflection point in terms of sustainability and the shift to electric vehicles. And what both of those things require is heaps and heaps of copper. And what's difficult is to bring on a new copper mine in any short period of time. So even if you had an amazing deposit today and you had all the funding, you'd be lucky to have that mine producing in 7 to 10 years' time. And in that intervening 7 to 10 years, we're likely to see about a 30% increase in copper demand. And it's going to be very difficult just to sustain current production, let alone grow it. So a lot of the companies that we're looking at globally and in Australia in the copper space, we think are basically looking backwards in terms of their share price. People are viewing them in the context of the way the world was for the last 10 years and not with the context of what's likely to happen over the next 10 years. So if you look at a company like Sandfire in Australia or a company like Capstone in Canada, they're trading on basically the same share price that they were a few years ago, despite the fact that the outlook for copper is undoubtedly better. And what you're essentially betting on is that this transition to electric vehicles and this transition to solar power and wind farms, which is incredibly copper intensive, that's likely to happen, which we think is a relatively safe bet. The other part of the market we really like is what we call cash machines. So these are companies that trade on very low PE multiples. They generate huge amounts of cash flow. They've typically got very under-geared balance sheets, and you're likely to see these companies return a lot of that capital to shareholders through dividends and buybacks. Some of the names are sort of household names that everyone would know. Companies like BlueScope Steel, Qantas, QBE, they're trading on single-digit PEs. They've got excellent management that have been able to prove themselves over a long period of time. Most of them are also at a positive inflection point in terms of their earnings cycle. So particularly in the case of QBE and BlueScope, we think there's upside risk to consensus forecasts. So it's not a case where you're buying a company that looks like it's on a low PE, but the earnings are not reliable. We think, if anything, the earnings are likely to beat. So hopefully it gives people a few ideas that they can go away with.
That's more than a couple, so that's great. Thank you very much, both of you. We've had a question from Max, one of our shareholders, and he wants to know what will be the biggest influence on the Australian dollar this year? Is it China reopening or the imminent US slowdown? Maybe I should go to Jacob for that.
Yeah, look, I think, it's a good question. I think the Australian dollar will tend to trade around, China more than the US. I think the US slowdown, they probably work together anyway. Like, we think China's accelerating at the time that the US is slowing down. And, both of them are going to be positive for the Aussie dollar because, obviously China takes our exports, and currencies are also driven by interest rate differentials. And, you've had this big, we call it policy divergence, i.e. the Fed's been really tight. The RBA's probably been pushed to tighten, but now interest rate differentials will move the other way as the US slows down, especially if the US is experiencing some systemic issues. So the only, I think both work in favor of the Aussie, but the only caveat to that is, the Aussie is not typically associated, it's not really a risk-off currency, right? Like, it's arguably the yen tends to be much more defensive, but all else equal, we think it's okay.
Excellent, thank you. I've got another question. This one is to Mark. Obviously, you've just expressed that you're very cautious in your outlook. How much cash are you holding, and how does that compare to your historic levels? And are you sort of waiting on the sidelines, really, to start investing again?
So essentially, we talk about a net long position. So if we're 100% net long, we're essentially fully invested. If we're, as of today, we're sitting at a 50% net long, that basically means we've got half of our portfolio essentially in cash. But it's a little bit different to a long-only fund. So just bear with me and I'll try to explain. Essentially, we buy stocks, so we go long certain companies and we go short other stocks. And essentially, the net of those longs minus those shorts gives the net position. So when we talk about a net long of 50%, it doesn't mean that we don't have enough ideas to fill a portfolio. We've actually got lots of ideas that fill the portfolio, but the way that we get to 50% might be 130% long and 80% short, and that gets us to 50. So please don't, it can be under the impression we don't have lots of ideas. We've got 80 different positions in the portfolio. We've got more ideas than we have space in the portfolio. So it's actually a very exciting time from a portfolio management point of view, given all the different macro events and different inflection points in different sectors.
Thank you, Mark. And finally, Jacob, we've spoken in the past, and obviously you talk about monetary policy divergence. What do you mean by this, Jacob, and how do you think it will play out?
Yeah, look, as I mentioned, the Fed's been tight. Short rates have gone up a lot, and in the US, and but it hasn't really because most households have a fixed rate mortgage. It hasn't really bitten yet into consumer spending in the US, but all the other central banks in the world outside of China have to follow the Fed to a certain extent. And in most of those economies, we do pay variable rate mortgages. So the impact on the economy is much more immediate. So that's what we're saying about divergence. The Fed's been much tighter. Other central banks have lagged. And look, we think it's somewhat unsustainable. Something has to give. And you're starting to see real pressure in the household sector in smaller countries like New Zealand, Australia. We know this year, all the variable rate mortgages in the next 12 months will roll, all the fixed rate mortgages in Australia will roll into variable, and that will have a big, decent hit to household spending. We also see it in Scandinavia. So we see these economies are most vulnerable to what the Fed's doing. It's actually, economies outside the US that are more vulnerable to what the Fed has done. And we see consumer spending in those types of economies absolutely falling off a cliff. And that's, I think, exacerbating pressures in the financial system where you have high leverage. We can see pressures in the commercial property market. And we think in our long short fund, where, we've been taking advantage of those stresses to the benefit of our investors. And we think they will continue because, as you go, these things tend to get worse before they get better, because it's the tightness that's causing the stress, and it ultimately causes, a recession. So that's what we mean by policy divergence. And
before we wrap up, I have to ask you about Silicon Valley Bank. I mean, obviously, you've been sending out a lot of communications to your shareholders, and Tell us a little about shareholders about it in terms of regional banking in the US. I mean, I know you haven't got any exposure, but I'd be really interested, and I know our shareholders are asking as well for your thoughts.
Yeah, no, we don't. We've avoided the US regional banks because we just, we see them as actually being relatively weak banks, and that's the weakness is now being exposed. And the key issue in regional banks in the US is they, you don't have that you don't really have the ability to lend to mortgages, because most of the mortgage lending in the US is done by government entity, and it ends up being a fixed rate mortgage. Now the banks can buy the bonds to fund those mortgages, but they end up in a fixed rate bond. And what happened in the COVID period was, Silicon Valley Bank expanded its balance sheet. They had a lot of deposits coming in from Silicon Valley venture capitals, venture companies, and that deployed those deposit growth into these low-yielding bonds. Now, flip into a rate tightening cycle, and you start to see those deposits start seeking higher returns, but Silicon Valley Bank gets stuck because it has to pay more for its deposit. It has to make an unpalatable choice: pay more for the deposits and crunch its profits, or start selling the bonds. Now, the problem is the bonds now have a big loss on them because interest rates have gone up, and that's the story. And we've had the first, let's call it, social media-led run on a bank. But it's a microcosm of a broader issue of participants in the financial system who are exposed to variable rates, who are feeling the pressure of that, and obviously the pressure on the economy comes with a lag. We've really tightened financial conditions now in the US, and that will be on the Fed's mind. Yeah.
Excellent, thank you, Mark. Did you have anything to add before we go?
No, I think, for most people, they've never heard of Silicon Valley Bank, and it really came out of left field. And, it's the 16th biggest bank in America. It's not in and of itself critical to the financial system. But what it highlighted was that these aggressive rate rises can have consequences that you can't predict. But what you do know is that there is a real consequence to it, and it is likely to lag the actual rate rises. And you often see the weakest and flimsiest business models get exposed first. So it's a bit of a warning more broadly for investors and also for central banks that there are consequences of rapid adjustments in interest rates, and we're starting to see that.
Excellent, thank you. Thank you very much, both of you, from Future Generation to the shareholders as well. So thank you very much. I'm going to let you go now, and I can see that Geoff Wilson, our founder, is now in the room. But thank you very much,
Caroline.
Thank you very much, Jacob.
Thanks, Caroline.
Thank you.
That's technology talk in the room, because I've actually been in the room listening all the time, but it's maybe physically not physically, but my picture's in the room now.
Thanks, Jacob. Thanks very much, Mark. So, Geoff, before we kick off in terms of Future Generation, anything to add in terms of what you were hearing from Mark and Jacob?
Oh, no, I mean, they've really given you really good summaries of what's happening around the world. It's a difficult period. It'll get more difficult in the real world. Because we know the equity market sort of moves in anticipation 6 to 9 months ahead of what happens in the real economy, and that's what Jacob was saying, that I think Mark alluded to as well, that these sort of facts that we're seeing, the impact of those will be further down down the road, and it's going to be a tough 2023. Like, a lot of people thought, it was all over. Like, we've had the tightening cycle. We'll have slowdowns or recessions, and the market's anticipated that all. Now, in terms of what's happened, now we're seeing some of the cracks sort of open up from what's the tightening cycle, and Jacob explained it very clearly. What happened to SVB, and now we just don't know what those. What the other impacts are, because we saw that Credit Suisse was effectively semi-bailed out by the Swiss government. We're seeing there's a First Republic in the US being bailed out by was it 5 or 6 local banks. So there's and you'd assume there'll be more, and so that's the question is, how will the equity market form through that? And that's the $1 million question that no one exactly knows. And probably while we're doing that, I know you said earlier we're going to talk to the managers and talk about performance dividends and a few things like that. And if you look at the performance, and you probably let's look at each company. Let's look at FGX initially. and the performance numbers there, and then we'll go to FGG. Now,
excellent.
What both investment committees do, and there's investment committee with sort of high quality individuals from that spend their life picking fund managers, and that's the Morningstar, the Zenith guys, the Jana, so they're really good investment committees. And with FGX, they're looking together to put together the best Australian fund managers that they believe will add value, and they've skewed this is logically or is to boutique managers, because you tend to find someone who is running their own business has more effectively flesh in the game than someone that's been employed just to work for a salary and potentially bonuses. So that was the logic about the boutiques. And in terms of selecting the boutiques and looking at the portfolio we've got at the moment, you see that everyone see that on the monthly gaze. We've really got a combination of managers, and we've definitely got a skew to more medium-sized and small cap managers, and that's why, because when we're looking in the Australian context, trying to find managers, what we're trying to do is find managers that outperform the market over time, and it is challenging, and you tend to find the mid and small cap managers are the ones that can potentially add value. Now, the negative in the last, say, 6 months is, because we've got a skew to mids and smalls. So it's been a difficult period, and I think the mid and small caps, I know on a global basis, I think the cheapest they've been against the large caps for the last 25 or 26 years. So, so our managers have done a good job. In terms of how the portfolio is split up, we not only have, and we're just again focusing on FGX, we not only have long equity managers, but we also have other managers that can potentially short, and we, Mark Landau, the L1 boys are one of the FGX managers, and they can hedge their positions, and also, we've got so we've got the long equity managers, but we've also got the absolute managers, and that's pretty much like a little over 40%. You can see the exact figures in the monthly end days of each of those areas. So. And that's why we show you on the performance numbers the volatility. So what we're trying to do is give you the market performance, if not better, and less risk or volatility than the market. And both FGX and FGG, I think the volatility is about 2% less than the market, and that's the market 14% for the X, and it's for the Australian market, and for MSCI index it's a bit less than that. So that's pretty much, we're happy with the performance of the portfolio since inception with FGX. We understand in the last 6 months, why the portfolio hasn't performed that well. And I know we'll talk about manager selection and a little later, I think, because I saw a few questions come to that. So that's sort of FGX, and in terms of FGG. Go back a year and a half ago, when the market was, the market was adjusting, from a very strong growth market, and with interest rates starting to increase, to a more challenging market. We saw a lot of the tech companies over there fall significantly, and growth managers come under pressure. So the investment committee over the last, say, year or so, has done a lot more in terms of changing the structure of the portfolio. So, and maybe I'll address it here. The investment committee sits there, and obviously the investment committee decides how we want, what exposures we want in terms of absolute managers, long equity managers. There could be some market neutral managers or quantitative managers, depending on which fund. So the investment committee decides that, but then also, so that's more the bigger picture of the asset allocation. But then there's the individual managers that are managing the pools of each individual pool of capital, and the investment committee obviously scrutinise them very closely, and sort of the red flags in terms of if there's underperformance Now, or if there's outperformance, so I know we all are looking for outperformance, but sometimes if you've invested in a manager, you think he's a low risk manager and he significantly outperforms, then you might actually find out. That's when you've got to do, dig in a lot deeper, because you actually might find he's a high risk manager, not a low risk manager. Variation in performance from expectations. What we're looking for is the managers to outperform, the benchmarks we hold them against, and to outperform over time. But if they're significantly outperforming, then or significantly or underperforming, then obviously we'll look at them more in detail. If there's any management change, and personnel change, that's another red flag for us. And I'm just trying to think what are other red flags, Carolyn? I'm just trying to think. I think that's
when anything, if they take
that's right. Well, exactly. Yeah. If there's a bit of structural change, but also if it's all those changes if they start managing their money differently. Because we've invested with them expecting to manage a certain way, and we expect certain results. And if that's different, and so with from an FGG perspective, there was, in terms of changing the portfolio there were in a different environment. Some of the managers were finding it difficult to perform, but also some of the managers had personnel changes and structural changes. So it was sort of 3 strikes and you're out. So that's pretty much. I know that I'm probably covering off on a question that came in a little earlier.
Do you want to talk about how we brought some quantitative in there with Plato and Vinva?
Yeah, well, that was on FGG, and it was it's only about 6% of the whole portfolio, but it was more. We're looking for managers that can add value over time, and it was just we did have some quantitative managers in there a little while back, a couple of them, and then we didn't think it was the right time, and then we thought that these couple of managers that added quite good alpha or outperformance, that we'd add them to the portfolio, but it's only a small percentage.
And they were sort of within the 5 new managers that we brought in terms of Holowisco, Lanyon, and Mark Curry as well. But why don't we actually have some more questions on that? So why don't we turn now to dividends, and then perhaps go through to some more of the shareholder questions that are coming through. So we have a slide on here because I think one of the things that we are most pleased about was being able to deliver increased dividends for shareholders, during difficult times. As you can see from the slide there, FGX declared a fully franked final dividend of 3.25 cents per share, bringing the full year dividend 6.5 cents per share. But I think, importantly, that was an 8.3% increase on the previous year. And that represents a dividend yield of 5.8%, and that's grossed up dividend yield of 8.3%. And I want to mention also our dividend coverage here, which is 4.7 years. And I think one of the questions that's come in is about dividend coverage and how the board looks at it. So I think perhaps if we'll go to Future Generation Global first, in terms of the fully franked final dividend of 3.5 cents per share, which was full year dividend of 7 cents per share. And this was an increase of 16.7% on the previous year. So that represents a dividend yield of 6%, which is significantly above the average global equity market yield of 2.3% and the average US equity market yield of 1.8%. So I think the profits reserve there of 46.3 cents per share, that gives us 6.6 years of dividend coverage. And I think one of the questions we have also is about the key responsibilities for the board in terms of dividend policy. And Geoff, obviously being on both boards, I think it's really important that we explain the board's approach to how you make this decision and how we build up the profits reserve. If I could hand that to you, please.
Yeah, thanks, Carolyn. And the profit reserve had been building up over time, and then a couple of years ago we sort of there was a change in accounting policy which allowed allowed a lot of the unrealised gains to actually reserve, and that's really given both FGX and FGG a really good cushion. I think FGG's it's about 46 cents, and I think FGX is just a little under that 40-cent level.
Yeah.
So and that profit reserve will change by if the portfolio over a 12-month period, that's from the start of 1st of July each year, if it increases over a 12-month period, then then that's effectively profit that we can put into the profit reserve. And in terms of the franking, where does the franking come from? On FGG, it's sometimes when we've invested in these managers, and we've Carolyn said before, we actually changed 5 of the managers on FGG, then they would have made money for us, so we would have paid tax when that's been realised. And then with FGX, it's a bit we're in a better position there in terms of franking because we're getting the distribution from the fund managers. There's franking in those, and if there's any realised profit from changing managers, then there's an additional tax that we pay. So we're getting it both from our managers and also from paying tax. Where FGG, it's just from the payment of the tax. So FGG's ability to continue to frank the dividend at that rate, obviously that will be challenging. And FGX is in a better position. And the board's view was, if we have the franking, then it's better off in shareholders' hands rather than in the company's hands. And so that's why we're paying probably a higher yield than the market is. Well, obviously with FGG, it's significantly higher than the market, and with FGX, probably strongly higher than the market yield. So effectively, we've got to make more profits for the profit reserves to go up. There's a lot of protection there. Historically, when we were only for FGG was only when it was, in the early days, it was paying 1 or 2 cents. Now then we rule of thumb, we wanted a couple of years profit reserve up our sleeve, but the board's is comfortable, very comfortable with the significant profit reserves we've had or have. Sorry.
And maybe if I could just talk a little bit about our social impact partners. I think it's really important because this is actually what we're doing as well. I mean, as you can see from this slide, in lieu of management and performance fees, last year we donated 12.3 million to our social impact partners. And they all work, unbelievably hard and tirelessly with youth at risk and to prevent mental ill health in young Australians. And I think that's meant a lot to them. I mean, listening to all the stories and talking to all our not-for-profits, they have really suffered in terms of their fundraising and what they're doing. So that sort of surety that they will get some, money is really important. And as you know, we ran a process for new partners in Future Generation Global, and we're really pleased with the progress of those 14 partners so far. So we've got a fair few shareholder questions coming in, Geoff. I mean, maybe if I can kick off and we can answer them between the two of us. So you've spoken about the restructure of FGG investment portfolio. Thank you, Geoff. You're the chair of FGX as well in terms of the investment committee. Neil wants to know what you're anticipating and if you're going to be making any changes to the Future Generation Australia portfolio.
Okay, well, yeah, as I'm just one member of a group, and it's really we pretty much work on a unanimous decisions. So the FGG, I don't know if I'd go as far as restructuring, but it was just it was changing the management and as different allocations because it was a different environment. I suppose that's a fair call. In terms of the managers, there's. I suppose like a portfolio of stocks. You'll have say you've got 20 stocks in the portfolio, then there'll always be 1 or 2 that you're keeping an eye on, and that's the same with the managers. And some you're keeping an eye on for a period of time, and then there's a little bit of underperformance. You understand why the underperformance was there. Then they outperform again. And you've got to remember the managers we're picking, and you heard two of them earlier. Like they're very passionate. They're highly intelligent. They're very skillful at what they've done, and they've all outperformed over time. And in smaller periods. Like when there's dislocation in markets, then there can be more shorter term outperformance. But what we're trying to do here is find managers that can add value over time. Thanks.
Thank you. And the next question is from Don. So I'm reading this out now. Since the 2013 float at $1.10 in 2013, the FGG share price moved comfortably to the 145 to 160 range in 2021. With the dividends and philanthropic benefits, this was seen through shareholders, and they've remained supportive to be a good investment. Over recent months, the price seems to have stagnated and it's losing its appeal. Please explain why shareholders should remain supportive.
Look, that's fair, and obviously the good thing is these entities are listed on the stock market, and if you decide you want to buy more, then you can. If you decide you want to sell, you can. FGG, it's like the NTA at the end of last month was about a little over $1.37, and the MSCI in Australian dollars, even though there's enormous volatility because the Australian dollar's been a bit weaker, as of last night, the MSCI in Australian dollars was actually up 0.15%. I mean, you that wouldn't be your gut feel. I think when the Australian market, I think, is down 3.2%, over the same period. So the NTA is about that, around that. Well, actually, probably closer to $1.38. You'd assuming the managers performed in line, if not, add a little bit of value. So therefore, like FGG is trading at a big discount to NTA, and that's probably maybe. I think there's another question coming up on that, which we'll cover that off there. And also, one of the interesting things is now that FGG, in the old days, FGG was only paying a cent or a cent and a half or 2 cents. Now that it's paying, this year it's effectively paying 7 cents. Last year it paid 6 cents. A lot of people, they tend to forget that in their returns. If you looked at, let's assume the company's trading at, the true value of the company is the NTA, so it's $1.38. And then you're paying, then there's, 6 or 7 cents. This year it's going to be 7 cents. So, so you've got to do, that's what's that, 4.5, 5. Well, I think it was at 6% on the share price, but on the NTA, it's, still it's about 5, just a little under 5%, 4.8 or something like that. So, so if you're paying such a high yield, say the market over time does 10%, and say we're trying to do 11 or 12% with less risk. If you're paying 4 or 5% of that out, say you're going to do 11% minus 5%, then your NTA is only going to increase 6%. Now, I accept from 2013, it's been a tough period, and you look at the performance of the portfolio. It's performed broadly since then. I think within a percent or two, in line with the market. So with less risk. So in theory, you're taking less risk and getting a similar return. So it hasn't been fantastic. Myself as a large shareholder or foundation, a large shareholder. But obviously we'd like to see them trading at NTA, if not a premium. We're very confident we'll get there, and I think we'll cover that off on another question. And you just got to be aware that now that we're paying bigger dividends, and it's been more so the next couple of years, your return's going to be in a combination of that. And also you've got to remember, for us to pay you, say we're paying you a 5% fully franked dividend on NTA, then you gross that up, and it's, 7% or something like that. We pay the tax. So these are company structures. So that the couple of percent went out in terms of paying tax. So you really got to look at it, from before tax, basis to get a true comparison. So that's right. If we're doing 11%, 5% you're getting fully franked, plus there's 2% tax, and then your capital growth is only 4%. So, like, to me, and if we keep pushing the dividend higher, then it's going to be, there could be more skewed to the dividend rather than capital growth. So it's just to be aware of that. In the early days, I know FGG, we talked about, because we didn't have the profit reserve, we can only pay a cent or two out in dividends. We said, hey, look, it's more capital growth. Now you just got to be aware it's, there's a lot more yield than it was before. Thanks, Caroline.
The next question coming from Dennis, re FGG. There is still a significant discount against the asset backing. Does this surprise you, having regard to the age of the fund and the good dividend yield to shareholders? Your thoughts, please, read the share price versus net asset backing difference looking forward for 2023 and 24. Thanks.
Okay, well, that's right. Yeah, better get my cloth out and polish, see what the crystal ball's saying.
These are long-term investments. I think that's a good thing.
Perfect. The interesting thing is, and it's really probably because FGG, I talked about before how the Aussie dollar's fallen, so the MSCI in Aussie dollar terms has held pretty flat. Like FGG, like on sort of today's NTA, and this is I don't know what the NTA is. This is my guess, just adjusting it for the market. It's about a 15% discount to NTA. And FGX, because the Australian market's down 3.2%, let's just say the NTA is down by the same as the Australian market. This is as of last night. Then what did I work at? So the NTA probably live is around that 127 cents level. So, the FGX NTA discounts a little under that 10% mark. But both FGX and FGG, like, our plan is to, for them to trade at premiums to NTA, and historically they have traded at premiums, and they've been premiums of up to 10%. And it probably and what's happened over the last couple of years, there has been a bit of like dislocation in terms of we changed CEOs, and there was a period of before Carolyn took over, there was a 6-month period where we only, we didn't have a full-time CEO, we had a temporary CEO. And also, go back, was it 3 or so years, we actually, both FGX and FGG were trading at good premiums, and we had a lot of people that have missed out on the float that wanted to get in, said, hey, look, can we have an opportunity to get in? So we ended up doing an SPP and a placement to shareholders. And what we found, and normally you get a little bit of rotation of those people that come in and they don't quite understand what they're investing in. But soon after we did that, the market, it was that tough quarter in December when, the December quarter, I think 3 odd years ago, and the market, sold off quite significantly. And so a lot of people that came in on the capital raising, all of a sudden they were questioning why are we there. And normally you'd get probably 20% or even 25% of the people that you raise money from, deciding, changing their mind for some reason, which is crazy. But this time we got a lot more. Like, I think it was around that 45%. And what I assume the reason why that happened is because it just happened to coincide soon after we raised the money. Is global markets and the Australian market fell significantly. So a lot of people questioned, maybe I don't have the money to invest there, or they changed their investment strategies, et cetera, et cetera. So there's a rebuilding, and Carolyn's been in the that's been part of Carolyn's job. You would have noticed there's been a lot more sort of visibility on the FitchGen entities. There's been a lot of work done on communicating to shareholders. And please, if you have any other thoughts or suggestions, we're here because of you, and your shareholders are very valuable to us. Please give us the feedback. But I'm pretty confident. It's a tough period at the moment because of where the uncertainty and the volatility in the markets, and but we're both FGX and FGG have a very clear strategy. Both teams have been increased in terms of personnel quite significantly from 3 or 4 years ago. We do have our communication, shareholder engagement, marketing strategy that's being rolled out. And eventually what you find is the share registers, they tighten up. It is, I remember, well, I actually only did first year economics, but I remember first year economics, when they showed you that chart, the supply, demand and equilibrium. What we're trying to do here is, the share price is just a combination of, the people that are prepared to sell at that price and the people who are prepared to buy at the price as well. And that's where you get equilibrium. So effectively, the people that are selling, either they sell. Ideally, if the people selling it, they got all sell and then there's clear air. But really, it takes time. The people sell, and then it's really the people are buying that understand what we're doing, understand why we're doing it, understand the managers we've got. Want to back those managers. Believe those managers will perform. Like the dividend. Like the fact that we can grow the dividend, like the fact that it can be franked. So to me, it's really about the sellers selling and leaving, and your shareholders are there, staying there, and additional shareholders coming on board. And that's when you get a 10TA, if not a premium. And we've done that with a lot of the Wilson Asset Management entities. Some of them trade at ridiculous premiums, 30 or 40%, have over time. So, I'm incredibly confident that'll happen. It's just, unfortunately, it's a matter of time.
So a lot of the questions were around those two areas. So I won't repeat each and every one of them, but I will ring everybody that has sent a question in as well. One of the other questions that I will answer is on currency. And whether or not what we do in terms of FGG. But we don't actually take a view on currency at Future Generation, and I think that's important to note. But in terms of our asset allocation, we do leave that to the underlying managers, and some of them do hedge. And at the moment, it's Munro and WCM, and that's 13.3% are hedging, which provides balance to the portfolio as well. And if anybody wants any more information on that, ring me. We've also been asked a question in terms of what our top 10 holdings are in both of the portfolios. That's actually in the annual report, but I'll ring you and let you know, and I'll send it to you. And if anybody else wants that, please let me know, rather than reading out the 20 of them. But I'm just wondering, one other question that's just come in, please quote performance after fees. And I mean, we're in a very unique position.
It's quite simple. Yeah, well, it's quite simple. Like effectively, it's just the performance we quote is the performance after fees, because there's no fees. These guys are doing it pro bono. Yeah.
So, but that's good for us.
And just so you understand, we're in their main funds. So it's not. So we're in the funds where they live and die by that performance. So the numbers we are quoting are after fees.
I think
because we got all the fees done over that. Yeah.
And one other question was very quickly, Geoff, because I know that you can speak for this for hours. In terms of, do you think 3 million is enough to put in your super account? And did you want to give a quick update on franking legislation and super reform? But although I can direct everybody to an information event that you're holding on Monday, which is on the WAM website, if anybody wants to have more information. But I mean, Geoff, did you want to give a quick update on that? Because you had a few questions on it.
I've tried not to buy into the super debate because, fortunately, I have money in super. And the incredible thing is, we looked at the performance. If you're lucky enough to have, anyway, to me, if you can perform over time, your balance in super increases very quickly. Because there's that, the old Warren Buffett, the multiplier effect. So I've tried not to buy into that. But what I will say is I think it's appalling. What they're talking about is taxing people on unrealised gains. And see, what frustrates me about these type of policies, and there's been a lot of talk about the super one. It looks like it was done on the run. We're all being, we all thought it was something else, and then it came, this way. I was talking to one of our shareholders. Is a farmer, down in, down there just out of Goulburn. I think he's 6 or 8 kilometres out of Goulburn, and things were tough a while ago. So he sold half his farm and he put the other half in his super fund. Now the prices of the farmland has obviously gone up quite significantly because he's close to a regional centre. And he said, "What am I going to do? Like when they give me a tax bill, how am I going to pay it? I can't just sell, 2% of the farm or 3% of the farm." He said, "I had to sell half of it to survive, quite a period of time ago." So to me, it's that taxing on unrealised, I think is unfair. And in terms of, I've always been a believer. I don't know why they don't do a progressive tax. The people with more money in there pay more tax. The people with less money in there pay less tax. Like income tax. So I don't know why they can't do that. And to me, that's the more logical thing. And that's what we're trying to do. We're trying to have equality. So the people that get it, don't give the people with a lot of money in there a significant benefit. Tax them. Anyway, but that's that one. In terms of franking, again, I'm incredibly disappointed by the government because I'd quite high expectations for Jim Chalmers. And back when we had the battle on franking in 2018, 2019, everyone said like they had a view on Bowen, but they had a different view on Chalmers. And to me, the significant unintended consequences on the 2 bits of legislation that they're talking about is going to, I don't know if destroy is too strong, but the second order effects are significant. And a lot of people haven't read the legislation and don't fully understand it. And we've probably seen 30 to 35 politicians, Liberal, Labor, advisors, both sides, independents, Greens, and none of them understood the legislation. And what you've got, the 2 pieces of legislation, one is the buybacks, and there's a hidden paragraph in there which is effectively a hand grenade the Treasury's put in there. So, and these are the off-market buybacks. So if anyone in say 2 years' time or 3 years' time does an off-market buyback just to recapitalise the company, and like we did that when we set up FGX, it was the Australian Infrastructure Fund. We did a buyback to let everyone get out of NTA to restructure it. Now, if we were doing that today, even though we weren't paying a fully franked dividend, we would lose franking, and if we didn't have the franking, we'd pay a franking deficit tax. Like that is just appalling. So forget restructurings like that. And on the other part, which is the one that they're talking about only raising $10 million a year, that is the brutal one, because that'll destroy the opportunity for small and medium-sized companies in Australia, listed and unlisted, that need to raise capital to grow, pay tax, and need to pay out fully franked dividends. It'll destroy their opportunities of doing that, because the legislation says if $1 is raised at any point in time, 1,000 years ago or in 1,000 years' time, it's ridiculous, the legislation. If $1 is raised at any point in time and allows a company to pay, say, a $100 million fully franked dividend, then that fully franked dividend is unfranked. And small Australian companies that have shareholders, and we got a letter in from one of our shareholders, been going for 8 years, set up a company, been losing money for 5 years, finally starting to make some money, and paying tax in Australia, so has the franking, wanted to pay a dividend to his shareholders, but needed to raise more capital to keep growing. He can't do it. So to me, it's incredibly, sorry, actually, you probably shouldn't have asked me that question, Carolyn, because like it makes my blood boil.
Yeah.
And unfortunately, a lot of people just don't understand it. So if you are interested, we've got a webinar on Monday, and there's a Senate inquiry, and please put submissions in, and that's open till the end of this month. So from our perspective, we'll keep trying to fight, so the system keeps operating efficiently and effectively. So thanks, Carol.
Thank you, Geoff. I'm going to wrap up now, but we do have our roadshow coming up very soon, which hopefully you all have got an invite to. And so we would love to see you as we go across the country. So please do register in your city. If you have any questions, please email me direct, or any of the team, or Geoff, and we will come back to you as soon as possible, straight away pretty much. And I want to thank very much Geoff, our founder, but also Mark and Jacob for their time today, and to all of you, our shareholders, for your support of Future Generation. Thank you very much. Have a good weekend.